Hey everybody, this is Eric Chapelle, the South Jersey real estate guy working with Weichert Realtors in Cherry Hill. And as a kid, I can remember people telling me to get my ducks in a row. Well, today we're going to talk about getting your ducks in a row when it comes to preparing for a mortgage. So if you're a home buyer, you don't want to miss this. In this video, we're going to talk about your credit. We're going to talk about your debt. We're going to talk about your budget, and we're also going to talk about your documents, things you need to prepare for a mortgage. Getting your ducks in a row in preparing for a mortgage is basically preparing yourself financially, mentally, and organizationally so you can speak to bankers with a groundwork of knowledge and so that you are fully prepared to give them everything they need. And so one of the things that they're going to want to know is your credit score. So let me ask you a question. Do you know your credit score? Some people can say, yeah, absolutely, and they can tell you what their score is. Some folks will be like, well, I think it might be in this range. And others are like, I don't know. I don't even want to know. They're just terrified to figure out what their score is. But you've probably heard the word FICO score. Did you know that there are over 30 different FICO scores in the United States today? Not all of them are used for mortgages, but there are three primary ones that are used for mortgages, and that would be TransUnion FICO score, Experian FICO score, and Equifax FICO score. The banks usually pull those three bureaus to find out how much debt you're carrying, what your debt to income ratios are, how you have paid past debts, if you've got unpaid debts. All these things come to play when it comes to that financial score. So one thing that I've noticed lately is when I talk to a client about their credit, they're usually basing their numbers off of Credit Karma or some other bureau like that that's free to sign up, and it gives you an idea what your credit scores are. The problem with programs like Credit Karma is they don't use FICO scores. They use what's called Vantage Score. It's a different criteria. It's based on predictive models, and it doesn't show a true picture of what's going on in your life today. And so that's why most lenders do not use that. I'm going to put a graphic up here on the screen and hold it there so you can look at it. Now, a FICO score can range between, 3 something all the way up to 800 and something, and so will Vantage Score, but those scores don't mean the same thing. And you'll see that sometimes your Credit Karma will say you're a 650, but when they pull the three big ones, like I mentioned a minute ago, TransUnion, Equifax, and Experian, your scores could be lower, they could be higher. It's all based on the different criteria, and the ones that the banks use are the ones that aren't based on Vantage Score. So you might have an unrealistic view of what your credit is when you look at it through Credit Karma. I encourage you to talk to a lender and let them tell you exactly what your scores are and exactly what you qualify for. I will say this, you need a minimum score of a 626 based on those FICO scores I mentioned just to be qualified for a mortgage. If you're 680 or above, you're 680 or above, you will qualify for better terms, no question. But if you're over 740, you're going to get top tier terms, top tier rates. It's just going to work in your favor. So you want to try to improve your credit score, but first you got to know your credit score. The next thing I want to talk about in getting your ducks in a row is know your budget. Your budget is important. You might qualify for an ungodly amount of money to purchase a home, but when you look at the monthly payment, it might not feel very comfortable to you, even though the banks say you qualify for it and that you're approved for that amount, it may not fit in your budget. So let me give you some guidelines. You ought to stick to what's called a 28-36 guideline when it comes to your budget. In other words, 28% of your income should be spent on housing and no more. You may qualify or be approved for more money than that, but you should try to keep it as close to that 28% as possible to stay within your budget so that you're not becoming house poor. You know what I'm talking about. It's those people who buy those big ghastly houses and they have no furniture in them because they can't afford to put furniture in them. So you don't want to be house poor where you can't live life that you're strapped just to a mortgage. Don't let that happen. Remember the 28-36 rule. You say, well, what's the 36? that your debt should not exceed 36% of your gross income. So your housing should not go beyond the 28% of your gross income, and your debt should not exceed the 36% of your gross income each month. That is knowing your budget. Stay within those guidelines and you should have no problem getting a mortgage. So now it comes to the next thing on our list, and that is your debt. We've talked about your credit, we've talked about your budget. Now let's talk about your debt. Banks are going to focus squarely on credit utilization. They call it your debt to income ratio, but credit utilization is a big deal to this. You may have multiple credit cards. And the way this works is they add up all of the highest numbers, like what is your credit limit for each credit card. They add all those together. They take your debt that you owe to those credit cards, and if they're maxed out to the limit, if they're less than maxed out, they add all that up and they divide it. They try to see what percentage of the debt that you've been allowed to have, or the credit you've been allowed to have, and how much of it is actually debt. If it exceeds 30%, you're in big trouble. So you say, well, what can I do? How do I get it under 30%? Pay down some of those high interest credit rates. There are some credit cards that charge you a higher interest rate. You should pay them down. If you are maxed out on any of your cards, you need to pay them down and get them close to 30% or less. Get as much of it paid off as possible. And sometimes you may have credit cards that have zero balance and some that have a high balance and you're almost maxed out. Maybe take some of that debt from there and transfer it to another card so that your utilization shows that you're right around 30%. The number is still the same amount of debt. It's just you don't have it all owed to one person. Also, some of those old credit cards, those old accounts you have that may have a zero balance, don't cancel them. Those are the ones that are going to help your credit score because there's no balance on them. And even though you have a credit card that's just sitting out there, that's not the one you want to get rid of. The one you want to try to get rid of are those $700-800 credit cards that are just lingering there, that are maxed out. Pay those suckers off as fast as you can to improve your credit score. Now, the last thing I want to talk to you about is your documentation. Most people are not prepared at all. Their ducks are like wild monkeys. They're flying around doing everything. And especially when it comes to having documents that are necessary to getting a loan. So let me give you a list of some of the documents you're going to need, and when you speak to a lender, to get a mortgage approval. One, you're going to want to have at least 2 years of your tax returns. So they're going to need that summary page from your tax returns for at least the last 2 years. You're going to need at least 2 months. You're also going to need about 2 months of bank statements, whether it be your checking account, savings account, both, whatever account you have. Gather at least 2 months worth of statements for each account and have them ready to be provided to your lender so they can help you as far as getting a pre-approval for a mortgage. W-2s from your work. Now, if you're self-employed, it'll be a 1099, or if you're a sales type person who gets a 1099 form, you'll need at least your 1099s for the last 2 years as well. So your W-2s, your 1099s, you're going to need to have those set aside and prepared to give to a mortgage lender. Also, you're going to need an ID, a government issued ID with your photograph on it and a social security number or a tax ID number. Those things are really important for you to have all set up and ready to go. So when it comes time to talking to a mortgage banker, you have all your ducks in a row. Now, by no means have I exhausted all content when it comes to being ready for a pre-approval or for a mortgage or talking to a mortgage lender. But the things that I have given you will give you a great leg up on everybody else out there who just kind of, I want to buy a house. Can I go look at a house? They have so many steps to go through just before they can even make an offer on a house, let alone getting a mortgage and being able to buy a house. So please take my advice on these. I know it'll help you. It'll help you get prepared and getting your ducks in a row. Again, my name's Eric Chapelle. I'm the South Jersey real estate guy working with Weichert Realtors in Cherry Hill, New Jersey. It's been a pleasure talking to you. I appreciate your time. Thanks again. We'll talk again soon.